Hello, welcome to Edubbey dynamic page. Today, let us look at FOMO in cryptocurrency. Fear of missing out, FOMO, is a powerful psychological phenomenon that often influences investor behavior in various markets, including the cryptocurrency market. FOMO refers to the anxiety or apprehension that one might miss out on a lucrative opportunity or exciting event, leading individuals to make impulsive decisions to participate, often driven by emotions rather than rational analysis. In the context of cryptocurrency, FOMO can have significant effects on market dynamics, prices, and trading volumes. Here's a closer look at FOMO in cryptocurrency. Price volatility. FOMO can contribute to heightened volatility in cryptocurrency prices as investors rush to buy into a rapidly rising market, driving prices even higher. This can create a feedback loop where rising prices fuel more FOMO-driven buying, leading to speculative bubbles and eventual corrections. Herd mentality. FOMO tends to amplify herd behavior, as investors follow the crowd and make decisions based on the actions of others rather than their own independent analysis. When a cryptocurrency experiences a sudden price surge, FOMO-driven investors may fear missing out on potential gains and rush to buy, further fueling upward price momentum. Short-term trading. FOMO often leads to short-term trading strategies, where investors seek to capitalize on short-term price movements driven by FOMO-induced buying or selling pressure. However, such strategies can be risky, as they rely on timing the market and predicting the behavior of other investors. Pump and dump schemes. FOMO can be exploited by malicious actors in pump and dump schemes, where individuals or groups artificially inflate the price of a cryptocurrency through coordinated buying, pump, then sell off their holdings at a profit once other investors FOMO in a dump. These schemes can result in significant losses for unsuspecting investors who buy in at inflated prices. Emotional decision-making. FOMO-driven decisions are often driven by emotions rather than rational analysis or long-term investment strategies. Investors may fear missing out on potential gains and make impulsive decisions to buy into a cryptocurrency without fully understanding its fundamentals or risks. Risk of losses. FOMO can lead investors to overlook or downplay the risks associated with investing in cryptocurrencies, such as market volatility, regulatory uncertainty, security vulnerabilities, and the potential for loss of capital. This can result in significant losses when the market experiences a correction or downturn. Mitigating FOMO. To mitigate the impact of FOMO on their investment decisions, investors should focus on conducting thorough research, developing a sound investment strategy, and maintaining a disciplined approach to investing. This includes setting realistic goals, diversifying their investment portfolio, and avoiding the temptation to chase short-term gains based on FOMO-induced market hype. In summary, FOMO is a common phenomenon in the cryptocurrency market that can drive investor behavior, influence market dynamics, and contribute to price volatility. While FOMO can present opportunities for short-term gains, it also carries significant risks, and investors should exercise caution and diligence to avoid falling victim to impulsive decision-making driven by FOMO.